Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
I am doing all good here, Joe. The snow has melted here in the Seattle area after what felt like, I guess it wasn't snow Armageddon here because they got it elsewhere, like in Texas and these places. So I don't think we should feel bad. But I did try to drive up to Stevens Pass yesterday, got up the kids, which is always painful, at 6 in the morning, actually at 5:30 in the morning, got in the car, booked it up to Stevens Pass. I thought that it was going to be closed past the ski area, but they closed the whole roads down. We never made it. So instead of getting our exercise on the slopes yesterday, we pounded down some biscuits and gravy at the Sultan Bakery and Cafe.
Nice work.
Yeah. So, I wouldn't say it was a bad day by any means, but definitely the opposite of what we were hoping for. So where are you at? You're still in Colorado?
Yeah. So we were getting dumped on last night. So we decided, hey, let's try and get up extra early and get a couple of runs in before the podcast this morning. So we packed up the van, headed up the slopes, got to the first parking lot, which closed right as we got there, had to turn around, go to the second parking lot, got parked, hopped on a gondola to get to the second gondola, which had an hour and a half wait line already before the thing was even the ski resort was open. So long story short, I got one run before I cruised back down to the van to hop in and join you all here. So it was very nice though. It was like 8 inches.
What's your sob story for the day? You got one?
Well, I got invited to go skiing yesterday. I'm here in Idaho, and it's always snowy on this eastern side. We're near Driggs and Jackson and Targhee and Kelly Canyon and a few. I got invited, but I was like, I got too much to do today. So I knocked out a bunch of stuff. It was still a very productive day. It's one of those quiet days where no one's bugging you. You get a lot done. And that's almost nicer than skiing sometimes. But so I almost got on the slopes yesterday. So we all kind of got snuffed, I guess, into some.
I guess so. We got snuffed. Well, I'm always looking for a good transition. So I guess I'm going to say today we're talking to Mr. Mark J. Kohler. A lot of you guys already know of Mark and his firm KKOS, but we're going to get to know him better today. So we don't all get snuffed in our taxes, in our asset protection, in our partnerships, which is one of the things we're going to talk about today. So for those of you who don't know Mark Kohler, I'm going to cheat. I'm going to read my notes here, guys, because we don't do things perfect around here. Mark Kohler of KKOS is a lawyer and a personal and small business tax and legal expert. It sounds really nerdy what I'm saying today, but he helps clients build and protect wealth through wealth management strategies, business and tax remedies that are often overlooked in this challenging, ever-changing economic climate. I think a lot of you know Mark, and his seminars have helped tens of thousands of individuals and small businesses navigate the maze of legal, regulatory, and financial laws to greater success and wealth. And rather than jump into all his credentials, we're going to let him speak for himself today and let you know how you can stay plugged into Mark and all his education and his books and everything that is going to make your life easier. You're going to be able to breathe today after you get some of these detailed nuggets we're going to drop for you today on tax and legal planning. So without further ado, Mark, thanks for joining.
Thanks for having me, guys. I'm excited to be here. And yeah, this is going to be exciting. Tax and legal. And don't change your dial. I know that probably, some of you have PTSD of an accounting class in high school or college and said, I got to get out of here. But no, this is going to be good. You're going to want to hear this.
This is going to be good, guys. I promise you. Trust me. But let's kick it off. Let's get to know Mark a little bit, Bauer. So, Joe, let's get going on this one.
Well,
yeah, I get Mark, we'd love to dig in and figure out, where you came from, how that got you to where you are today, and especially how did you end up near Driggs? Because that is such an awesome place if people don't know about that.
Yeah, it is. It's a really good secret. Well, oh my gosh, since I'm a millennial, it won't take that long, or at least I try to look like one. But no, that's not the case. So anyway, I'm a Washingtonian. I grew up in Washington all my years.
Woo-hoo!
So I was on the dry side, the Tri-Cities, and grew up there and just fell in love with Washington. I've always gone back 2 or 3 times a year. My parents lived there until after my dad passed away, and then my mom's moved closer to some other family. But I'm back in Washington all the time. So I'm a Hawks fan, Wazoo and UW and all those goodies. Been everywhere in Seattle and been there, done that. Been up Stevens Pass, Dwight Pass, the great ski resort up there too. But anyway, professionally went through University of Utah, actually, Salt Lake City. And Joe, you'd appreciate, I was actually a ski instructor at Snowbird for a while. And so
nice.
But they gave me the bunny hill. I had the bunny hill, but hey, I got my free pass. So
heck yes. Snowbird's great. Love it there.
And it was in college and all the cute girls were on the bunny hill anyway. So that's right. That's where all the instructing really took place. But anyway, but went to University of Utah, and then got a master's in accounting. Went on to law school back in Oregon, at Willamette in Salem, Oregon. And now, 20 years later, wife and 4 kids, and we lived in southern Utah for 8 years. Then we were in California for 8 years, and then we've been now in Idaho for about 4 or 5. We got out of the rat race of Orange County. And I love California and the people there and the food and the access to everything. But the cost of living is crazy. And how can I be a self-respecting tax lawyer and live in California and pay those taxes?
Right.
So we have a place we go visit there. We can talk about, state taxation. You Washingtonians have it good with no state tax, at least on your income. The state tax is kind of crappy, but anyway, so
Mark, why did you decide to be a CPA and a lawyer? Like what was it that made you go that route? Because as we discussed for a second, I also studied accounting and passed the CPA exam in my youth. But you obviously, what was it that drew you to it? Just curious.
You bet. Well, I grew up as an entrepreneur. I was the kid that always had a lemonade stand out on the street, and my dad was a microbiologist, which sounds very techie in a lab, which he was, but he also ended up running the labs and buying labs. And so he became an entrepreneur, which always was the bane of his existence. He always wanted to be behind the microscope, and he ended up running labs before the big HMO boom in the 80s. And so he had rental properties too. And I every Wednesday night and Saturday night, we were cleaning rental properties for the commercial buildings he owned. And so when I went off to University of Utah, I said, I'm starting my own small business, and had a janitorial business that got us through college. And when I started taking business classes, I really believed that the lifeblood of business is the numbers. If you know the numbers, I really felt that management and finance and marketing came more naturally to me, which sounds odd. So I really pushed myself to be in the accounting course. And I'm still a nerd, but I stood out as a little more normal nerd. And probably Michael Anthony Hall in 16 Candles. I kind of led the nerds. So, but anyway, I just fell in love with the numbers because I really felt it would make me more skilled as a accountant. And then I had this teacher who was a tax lawyer, and I thought, oh my gosh, that is the creme de la creme.
Is that was that the crux of the thing there? You had a teacher that was a tax lawyer, and that got your attention?
It did. And I had a couple friends, and my brother was just going off to law school. And so, you know how in life there's multiple factors, but that was a big one. And I thought being a tax lawyer, but I wanted to do it for small business owners. And so what we do now, I'm in this may be a good transition to say that I'm a senior partner in an accounting firm and a law firm, and we have our self-directed trust company. Those are kind of our 3-legged stool. And I really tried to focus on the small business owner from day one, and which means you can't live in a small town and then not do divorce and criminal cases and DUIs because there's just not enough business law to go around, especially tax law. So I immediately started to expand to a national type practice with a great team. And over 20 years, we now have over 100 employees between the 3 firms, and we help clients in every state. And but I can still live in a small town, and I love Main Street business. I love entrepreneurship and rental property. I own rental property myself. In fact, this afternoon, I'll probably be swinging by one of my rentals, picking up some stuff. And my daughter and son-in-law just made an offer on a new place that's a triplex this last month. Great. And I'll be helping with that, I'm sure. So, but my rentals don't do well. I lose money because all I do is help my kids make money, and then I leave. So, but that's me. So hopefully I relate to some of you out there as an investor or small business owner, because that's what I do.
That is for sure. I will say, as a little side note, my daughter, I have twin 12-year-old girls, and one of them came to me yesterday and said, Mom, this is Addison. I'm using her computer. My name's Julie, but this is Addison's computer today. She said, Mom, the plush toys or whatever these squishmallow things are in such high demand that if we go buy 5 or 10 of those right now from Walgreens, I'm going to turn around and I'm going to set up an Etsy account and I'm going to resell them. She's 12. And I was like, that's my girl. That's my girl.
You said, call Joe and get the money and let's do it.
That's right. She's like determined, pounding me all day long. Let's go. They're going to get sold out. So there you go.
So she needed a partner.
She needed a partner. So that's why we're recording this podcast today for her. So now let's jump into it, because we could goof off all day. All right. So I'm going to start off a little slow for you guys today out there in podcast land. And we're going to build into one of the topics that we've been discussing, is kind of a hot button with our crowd, about partnership structures and, best way to do that, and problems and pitfalls and entities and all that. So first, let's just go slow. When is the right time for somebody to set up an LLC in their business? This is for people just getting started, or people that are solo that are like, this seems like it's turning into a business, or I want to do this more than once. When's the right time for somebody to set up an LLC?
Wow, that's a big question. That's kind of like, when should I start growing a crop of bananas? Well, there's lots of factors. I will say there's 3 purposes or 3 places an LLC is used most commonly. I'd say 95% of the time for us out in the small business world. First is when you buy your first rental. Done. I got a rental. You're going to close in your name. You're going to jump through all the bank's hoops, Fannie Mae, Freddie Mac, whatever the freak the bank wants. And then after closing, you're going to deed it to an LLC. Don't worry about the due on sale clause and thousands of transfers for our clients over the years. The bank's already sold your mortgage to 3 hedge funds over, and they just want their payment. They don't want to foreclose. And a lot of mortgages have no due on sale clause provision when you transfer it to your own LLC or trust. So the first place LLCs make sense is when you buy that first rental. And I know today you want to talk about buying rentals out of state. How many rentals do we put in one LLC? I mean, that's a whole conversation right there. But that's the first place LLCs are great, is for holding rental property. Number 2, I like LLCs for the person that's just starting a business that's an operational business. And we know that in the long run, if you start making 30 or 40 grand net, you're going to want to be an S Corp. But a lot of times, if you're not making money right out of the gate, I don't want to set up an S corporation. I'd like to graduate into it, but I can't backdate into an S corp unless I have an LLC to begin with. Now, that's a whole other conversation too. We kind of call it S corp insurance.
So what you should say, though, is that if somebody has an LLC, they can back it up into an S corp.
That's right. So for an operational business, I'll use an LLC. Now, that's not going to be the same LLC you hold your rentals. This is a sister company.
Let's qualify operational business. You're a handyman. How about a real estate broker? Is that an operational business, or a general contractor for others? You know what I mean? And you're not, any of that.
Your daughter selling on Etsy, selling on eBay, a product, a service, a realtor, a contractor, an engineer, a plumber, electrician, a CPA, attorney, dentist, doctor. When they're just coming out, a lot of times we'll set up the LLC and then see how the year goes, and then backdate it into an S corp. It's really expensive. We charge $150 to backdate. So it's terrible. But don't go out and set up an S corp, folks, unless you can. So the LLC is kind of a preliminary operational entity to be an S corp. And then I'll shut up here. Then number 3 is for partnerships. So if I'm going to partner, I'll say this, for example, if Joe and I, this is just in general, I know we'll peel away the onion, but say Joe calls me up and says, hey, I want to do a development. We're going to buy this apartment building and turn it into condos. So we're going to buy this land and develop it into lots and build specs. That's ordinary income. That's short-term income. That's not long-term. So we might form an LLC, but my S Corp would own my share of that LLC because it's an operational LLC. But then, the next day, Julie calls me up and says, hey, Mark, I want to buy this cute little duplex over in Spokane. All right, cool. Let's do it. That would be a different LLC. That's a holding company LLC. Now, a holding company partnership, I would have my trust be the partner. I don't want my S Corp anywhere near that. So you can have holding LLCs and you can have operational LLCs with partners. Anyway, that's a broad view. So.
There you go. This is like, you guys don't overthink it. You just got your answer. So just
We're done.
Okay. KOS and get it done. Let them tell you what to do, right? There you go. You don't even have to think about it. So that leads me into my next question. Should I have an LLC or an S Corp? And so there's a threshold that it sounds like, or some other things that make sense to graduate, as you say, use that word, into an S Corp. Tell us about when that happens.
Well, your question's kind of interesting when you say, should I have an LLC or an S Corp?
Well, an S Corp is an LLC, right?
Well, I would say this. If you have an operational business, you're going to want an S Corp, period. The question is, when do I do the S Corp? And so the LLC is just kind of like a S Corp in waiting. It's it's just kind of that little handmaid that's there. You're running the business as an LLC until you can make it an S Corp. So I'm mincing words here, but when you say, should I do an LLC or S Corp? Initially you could do an LLC if your income hasn't really hit that threshold of around $3,000 to $4,000 a month. Once you start netting $3,000 to $4,000 a month, call your mom and then call me and let's set up that conversion process. It's a 2553 and a special revenue ruling you attach. I can backdate it more than 75 days. I'll only go up to a year back because we've got to worry about some other issues, a whole other topic. But anyway, so if you're not making a bunch of income yet, you think you might hit a home run this year, you got a little liability exposure, just start with the freaking LLC. Now it's not as, so.
All right, now let me see if I can, you've sort of answered this, but I'm going to see if I can layer it a little more complicated. So what if somebody is a real estate agent, a general contractor, and an investor, right? They're all three. They work as a real estate agent for their day job, let's say. They're a general contractor, so they can work on their own properties, and they're an investor. We get a lot of those types, right? Some combo types. Is there a better entity set up for these people, or?
Well, I told you before the podcast, don't throw me softballs, and this is certainly not a softball. And this has nothing to do with partnerships, so just FYI.
Yeah,
so
right. I'm just getting warmed up. I'm going to.
Oh, okay. Yeah, we're warming up with this. This is like a curveball at 90 miles an hour. Okay, so let me say from an IRS standpoint and from an administrative standpoint, I would have you in one S Corp. If you're a realtor and a contractor, and remember, short-term investor. I'm not talking about rentals. You're talking about fix and flips.
Right.
Because we got to be careful of saying, oh, I'm a real estate investor. My next question is short-term or long-term? Oh, I buy rentals. Then say you're a long-term real estate investor. Don't just say investor. I want to know, are you fix and flip and rentals, or which one? So anyway, in this example, you're saying that you got a fix and flipper that's also a realtor and a contractor. For IRS purposes and keeping life simple, I want you to be, and you're gonna be making enough money. You should just be an Inc. Just Julie Real Estate Enterprises, done. From an IRS perspective, they don't care. I don't care. I think that's great, and it's going to be so much more freaking efficient. But we have a couple problems. First one is the state licensing boards. You're going to have problems trying to keep the real estate division happy with all of your RESPA laws and all of the things you have to disclose when you're a realtor in any sort of transaction. And it's going to jack up your fix and flips because you're going to have to disclose you're a realtor. Then you're a contractor. You're going to need a certain type of insurance policy for that. And the exposure and being a licensed contractor requires other types of disclosures. So you've got a state licensing board issue. And then the second major problem is there's exit strategies for all three of those. So if you're a realtor, we might be building up a book of business to ultimately be a broker and manage rental properties. And that we want to keep that as a separate entity possibly. And then the contractor, you're going to ultimately have employees or vendors or subs, and that's going to need its own type of structure and its own bonding and insurance. And then you're going to be flipping, and you're not going to want to flip in your name, but you're also a licensed realtor. So you got problems there. So
basically everybody's going to have a unique situation that needs to be probably a little deep dive consult on something like that, right? It's too many factors to cover
but it's a good one. And I would say this, ultimately, if possible, I want one S Corp, and then your subsidiaries are single member LLCs. And so like me, Mark Kohler, I have one S Corp. I got 15 CPAs and 7 lawyers and a law firm and accounting firm. I could have as many S Corps as I want. And really, it wouldn't cost me anymore. But it's a headache to do that. I don't want that. So I have one S Corp. So if Joe calls me up and says, I want to do some development, we're going to form an LLC and my S Corp would be the owner with him. I'm not going to set up a new S Corp for that. And then if you call me up, Julie, and go, hey, I want to start selling these little dolls on Etsy. All right, cool. I'm going to let my S Corp own that LLC. And so my S Corp is the partner in any operational LLCs. And in your example, I've had clients that are contractors and realtors, or contractors and investors, or realtors, but it's very rare that we pull that off. And if you're married, I may even put one of those entities in your spouse's name to create some separation for your repsies and stuff like that. Anyway, big topic.
Big topic. That's a good topic. Get professional advice if that's you, a combo. Okay. I don't even know if I want to ask you this one. Maybe I'll skip it. I was going to say, when
I'm
does
married.
it make sense?
I appreciate that though, but I'm married and it's really kind of you to ask.
Those are the unrecorded questions, not the recorded questions.
Okay. Just want to get that out there,
Don't give away my MO for, off camera. Come on now. Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show. Now, I don't even know if I want to ask this, but I'm gonna because I just like to see what happens. What is a series LLC, and should we even talk about it or not?
Corey, do we have a tax and legal playbook over there?
Oh,
I'm asking my producer if I have one of my books. Is that one of them right there, Corey? Hey, Corey, is that a tax and legal playbook right there? If you could grab it. So in my book, The Tax and Legal Playbook, which I really feel is a great handbook for any real estate investor out there, shameless plug, sorry. But that's in the back, I have a table.
At the end anyway, so we're good.
Yeah. I have a table that shows all the states that are series LLC states. And Washington is not one of them. But that issue comes into play first. You can't use a series LLC in a non-series state, period. So when someone goes, what's a series LLC? I go, where are you buying your rentals? Washington and Arizona. Well, it doesn't matter anyway. You're not going to use them.
Got it.
You get so series LLC is used in states where there's series law, but that goes back to the rental property side. When we're talking about rentals, we might use a series LLC that acts like a parent, and we can have as many baby sub LLCs as we want. I'm not saying I'd set one up for every rental. I don't, which might shock some of you. That's another topic too. But I like the series LLC in states where you're buying rentals. Let's say Tennessee. A lot of clients down there in Nashville buying rentals. Well, I might set up a series LLC because I don't have to set up a bunch of LLCs. I can have one series. I can file one tax return, but have baby subs to separate liability. There's about, I could read off the states, but there's about 13, 14 states that are series. And I constantly update.
We're going to make everybody buy your book at the end.
All right, there you go.
We might even give a couple away.
Yeah, we're going to give one away
here. All right. Well, let's keep going there because now we know that the book can give us some further guidance on that too. And we can just like a series LLC and all this stuff, we can do a series of podcasts with Mark. There you go, guys.
And Julie, before you ask a question on partnering, because I know I've got a big point to make there, but one other side note, if I could. People, this is so important. On all this LLC stuff, please do not think that it's as simple as, well, I can set up as many LLCs as I want. I just go to the state. I pay a $50 filing fee or whatever the freak it is in my state. I don't need a lawyer. I don't need this. I can just set them up at the state. People, don't use me. I don't care. But do not think that that's an LLC. That's about 1/10 of an LLC. You need an operating agreement. You need minutes. You need a corporate book. You need membership certificates. You're going to have to file. Are you going to file as a member managed or manager managed? And all the pieces and parts that go with an LLC, if you don't have them, I'd love one of my clients to sue you in court because it's going to be worthless. Well, I don't need to have all that stuff. Yeah, you're an atheist in a foxhole. When the bombs start dropping, you're like starting to pray. And so I have clients, when they start getting into a lawsuit, they're trying to prepare all the crap they should have done to begin with an LLC, and it doesn't work because it's obvious you didn't follow those rules to begin with. So please just do it right. And we don't even have like this $5,000 or $10,000 retainer boot camp crap or unlimited LLCs for all this garbage. And we don't set them up in Nevada or Utah or wherever for you. We set them up where you need them. We're affordable. We've got a $450 set up as a paralegal service to get all the pieces and parts. And that's what it's going to cost you at LegalZoom if you check all the boxes anyway. But Robert Shapiro makes it sound so sexy on those commercials. Any LLC, $99 for step one. And then you get in there and you get upsold all this crap and you're like, oh, this is not what I thought. That's because you need all that crap. So
let's just get the elephant out in the room. Okay. So if somebody was going to do it correctly from the beginning, right? Or maybe you have to go backwards a little bit, but let's just go with correctly from the beginning. We won't worry about the bill that somebody has to pay if they go backwards. What is a decent number to get somebody started on the right path if they are wanting to buy rentals in, I guess, whatever state? You know what I mean? Is it okay, like you said, $450 to get that vote?
Yeah, and by the way, this is not an infomercial. I give you my prices just as kind of a starting point, as a barometer, because I have clients that it breaks my heart. I remember I was sitting in Redline in Bellevue with a couple clients once that had gone to some crappy, stupid Utah County company that had sold them all these LLCs, unlimited crap that they didn't need for $3,000 or $5,000, and it broke my heart.
Right.
And so you've got to watch out for that garbage. And in real estate clubs out there, Julie, I know you and Joe really protect and guard your listeners from not getting sucked into that garbage. And I wouldn't be here because
I actually find there's two camps of people. There's the camp of people that do what you just said, where they spend $5,000 when they don't even own anything, they don't have any assets, or they're just getting started, and they way overboard do something, I'm guessing. Or then there's the people that go the opposite and they don't even do anything. They just, and we're trying to get you guys just step one here, right?
Yep.
With, not having to go overboard, but yet doing something. And step one looks like ... What?
Yeah, okay, so here's what it looks like. If those two extremes is also the DIY, where I don't do anything or try to do it myself and it ends up being worthless and you spend a little money. Okay, so here's what I recommend. find a lawyer, that not a document preparer, not an online website, when you're just getting started. Now, I'm going to come to you professional real estate investors, been out there for 20 years too, so hang tight. But if you're just getting started, find a lawyer that knows what they're doing and pay them for the first LLC. Get a plan done. Get all your questions answered. Know why you're setting up what you're setting up. Every consult, we do a little diagram with our first client, and we build their plan for the year and what their checklist is. And we charge $800 for an LLC in any state, $800. And then you're going to have your filing fee, maybe registered agent fee, but it's $800 and you get an hour with a real tax lawyer on Zoom, on the phone, not in a cube somewhere. Or we have our paralegal service that's $450, where you have a paralegal prepping you everything, but they're not answering questions. They're just prepping what you need. So once you get your plan, and then you're on your second or third LLC, and you're like, oh, I just bought a rental in Georgia. I had my consult earlier this year with Mark or one of his lawyers. You know what? I can pull the trigger in Georgia. You call the paralegal and do the 450 thing because you already know kind of what your plan is and what you're doing, and you just need it done right. For you seasoned investors out there, pay once a year for a consult. Get a review. You may think you have it all dialed in. My goal on a call is to find the holes. Is your family trust coordinated in all these? Who's the owner? Are you doing all the proper K1s? Are you taking all the right write-offs? I love to look at a client's diagram that's been in real estate for 20 years and their tax returns, and then provide additional value by going, here's some pieces you're missing. Fine, pay us for 1 hour. Doesn't mean you have to marry us for a lifetime. Pay for an hour review once a year and get your asset protection a little updated. Then you can call the paralegals when you need something.
Exactly. There you go. There you know the numbers now. You have no excuses. Let's just get on with it. Just stop overthinking it or underthinking it. All right. So moving on. Can an LLC formed in one state own rentals in a different state?
Yes, but it doesn't give you protection. So for example,
we're in Washington, and a lot of people here like to buy rentals out of state because of our friend Jennifer Beatles. We love you. Thanks for hooking us up with those out of state rentals. If you guys don't know Jennifer, get to know her. But Jennifer and Mark, whoa, man, talk about dating. I should match you guys.
Let's get it going. Jennifer, okay, so that's awesome. I'd love to connect. So if I live in Washington and I buy a rental in Oregon or even in New Jersey, or I buy a rental any other part of the country, I can take my Washington entity and deed the property onto title of that LLC. So the LLC now owns it. Does it protect me? No, because you did not register it to do business in New Jersey. So your first option is I take my Washington LLC, I register it foreign in New Jersey to do business in New Jersey because the Secretary of State of New Jersey says, oh, you're going to come into my state with your little Washington LLC? Cool, but register it. Well, I don't want to pay the fee. Then get the hell out. So if you don't register it in New Jersey, you're not doing business there.
Is it better to just start a New Jersey LLC or use your Washington LLC and just register it?
Depends on your situation. And this is why I want you to pay for a consult once a year so we can peel away the onion. You successful investors are like, well, I just always register for it. Really? It's not what I do. But some people it works. What's your situation? How many rentals? What's the fair market value? Married or single? What's your long-term plan? Oh, well, maybe those factors should be considered by. Okay, we'll come back to that. Now, number two option is I set up a New Jersey LLC to do business in New Jersey, registered agent, mail forwarding, whatever. And then my Washington LLC could own that New Jersey LLC. Or I have my trust own my Washington LLC and my New Jersey LLC where they're sisters rather than parent and subsidiary. Man. I could go through three different variables.
If I had $800, I'd give it to you guys right now, just to.
Well, and when we do a second LLC for a client on a call, we always discount it or do the second one half off or whatever. We're trying to build relationships. But again, not an infomercial. But I'm just saying, there's so many variables. You want to figure that out. So the third option.
Go ahead.
Well, there's a third option we're not even going to. For those that are watching the recording video-wise, I'm just rubbing my forehead here because this is why I have a 2-day class online because these questions, Julie, are so freaking awesome, and we need time to really develop them. And I know you're so kind to have me. The third option is for my high-level clients that have maybe $1 million worth of equity in real estate. They've got 10 rentals, 5 to 10 rentals in 2 or 3 states. Now we're looking for an additional layer of protection. They got teenage drivers. They like to text and drive, who knows what. So I want to have a layer where I want a COPE entity, which is called a charging order protection entity. I maybe want more privacy. I want a little camouflage with my vest. And so now I want to hide you. I want privacy. And I might use a Wyoming entity. I'm going to get a lot better protection with the Wyoming entity from the outside. Then my Wyoming entity owns all my other LLCs. Now I've got a double layer of protection. I can do one tax return with my Wyoming 2-member LLC 1065. I can hide you as an organizer, a manager, and an owner so no one knows. And so you can find my S Corp. My S Corp runs my business. I want you to find me. You can't find my rentals. You got to have one hell of a court lawsuit with the discovery and a court order before I'm going to start telling you what I own. Now I report everything to the IRS. I'm not hiding there. I pay my taxes, but I don't want some plaintiff to figure out where all my stuff is. So you've got protection and privacy. They go hand in hand. Deep.
Hand in hand.
Deep, Julie.
Deep stuff. Again.
Okay.
There you go. Get on it, guys.
Okay.
All right.
Partnerships.
We're getting to our big question here.
Okay.
Partnerships. Okay. So what do you think about partnerships? For example, if it's a family member versus an external partner, does the number of partners matter for tax and legal? Or give us your in-depth rant here about how best to structure partnerships, whether it's with your wife or somebody in your family, or maybe it's like me and Joe, somebody where we're not related. Even though
if you really want to get into a lawsuit, just at your next family reunion, just go out and start raising money. I mean, that's wonderful. People love it. You can just do deals on napkins, take money from Uncle Bob and your brother-in-law. You'll never be invited to another family reunion. You'll probably have 4 or 5 lawsuits to boot. So I love investing with family because I just have job security. You can just write me checks every other day because you're so jacked up. No. Okay. We got to start with this. Partnering. Now, this is really, really important. And I think this will create a little bit of a structure for the remaining questions on this topic. There are 3 different people or 3 different types of money we need to keep in mind. There are lenders, there are partners, and there are investors. And there are 3 different things. You cannot be both. Period. Now, you may think, well, I've got this participation note where I get X% interest, and then when they make money, I get a piece of the action. Oh, you get a piece of the action? General partner, done. I just sucked you into a lawsuit. Over with. Period. See, once you get a share of the profit, you're a freaking partner. Period. You don't like that? Go change the laws in the United States.
For those people out there that are like you said, we'll call it a participating profits interest is what maybe some people might think that is. They are actually under the gun for any legal matters the moment they get a participating profits interest.
Yeah, absolutely. The end.
Right. So let's say an investor meets a seller, owner of property, and is like, "Hey, I would like to buy your property. And I'll flip it, and you can contribute to our partnership, and I will give you an upside piece at the end, some profits at the end." Right? There's people out there that are doing that.
Are there people really doing this still? I'm from the rooftops every day on every podcast or news station. I've been on King 5 probably 5 times, and people are still doing this. Drives me nuts. I'm just being a little tongue-in-cheek.
Well, let's deep dive.
It drives me crazy.
We rabbit hole around here. So what if you had a seller of a property that was like, and you wanted to incentivize them to sell you their property, and if you did better than you thought you were going to do, or you had some X threshold sale price on your exit as a flipper, let's just say, and you wanted to give that seller a bonus for doing that to incentivize them to sell you their property in the first place, how would you do that?
You would sign a partnership agreement with them and pray that there's not some vendor, some kid on the property, someone gets hurt, some mess, some lawsuit that could arise, which there's 50 different variables that could occur that go wrong. And I know some of you are like, well, Mark, I went to a class and the person that does this says it works great. I'm sorry, was that your lawyer that has malpractice insurance that if something happens, you can sue them? Or is this from a person that they're a successful real estate investor and that's the way they did it? And they said, I can do that too. And they gave me documents even, and I paid them to be my coach. And they're going to coach me and show me how to do this. And well, does that mean if something goes wrong, they're going to stand behind it? Bing, they're gone. Well, I go, did you have a lawyer review that and say that that was okay? No, I didn't want to pay for that. Or, yeah, I got it from a lawyer. You paid a lawyer, actually paid a lawyer that said a participating note is not a general partnership and you're not going to get sucked into that. Well, no. Well, go back and ask them for a letter that if you do, they will stand behind it and indemnify you and cover the lawsuit, because that should never happen. You think you're going to get that type of letter? No. People, we forum shop to get the answer we like, not the answer that's right. So let me throw this out. Okay. You jump, this is so important. We've got to dissect this a little bit, Julie. And you bring up an example of a partnership scenario that's fairly unique, that has a lot of entanglements. And I've got solutions for it, you bet, but it's going to involve more paperwork and disclosure and crap that you don't want to talk about, because when you're trying to get that seller to sign a document at their kitchen table, you're trying to dumb it. I've been there. I know what you're trying to do, folks. You're trying to close this deal at the kitchen table, get the seller to sign it over to you, and you're going to sell it and make him more money and give him a kickback. I love it. I get it. You want it simple. You don't want to overwhelm them with legal docs. I get it. But you've just created a general partnership with this person. And if anything goes wrong, you're all going to get sucked into a freaking lawsuit. And I see it.
Or how about if that person who you don't even know, that seller, has trouble on their end, then that can suck back up into your partnership somehow, or
right? You just made them a partner on the rehab and the sale. Anything that goes, if I'm a buyer, if I'm a vendor, if anything goes wrong, I'm suing everybody, right? That's what lawyers do. They find anybody that has a connection to that property in any way, shape, or form from a profit's interest, and they file a complaint and they serve everybody. Then you got to go hire a lawyer to try to get you out of the lawsuit, which is called a motion to dismiss. And they're going to fight tooth and nail to keep everybody that's got deep pockets, to keep them in the mix. And you go, well, this person's broke anyway, and da-da-da. Did you want to get sucked into a lawsuit? Anyway, okay, rather than let's hyper-focus on that transaction.
Your point makes a point that if you have a seller, sometimes the sellers are the ones bringing this up, right? Like, yeah, I mean, I want to participate somehow, then that's actually all their legal liability is, a way to maybe get them off that mark, right? To just basically let them know that they are getting sucked into a partnership situation where they might get sued. And actually, is that really in their best interest? Is that the best way for them to get this extra money that they think they want out of their property? Maybe they just need to go retail and sell it that way, right? Rather than partner up, right? The point is, it can be used in the reverse as a way to get them off that, rather than, you get what I'm saying?
Yeah. Well, yeah. There's lots of ways to handle it. And see, that's one whole podcast in itself, Julie. Okay. How to partner with a seller in a rehab to give them an interest. We could talk about it for an hour and a half, and I've got 9 different options. But let's just back to partnering in general, if we could. Okay, this is so important. If you're trying to raise money and you want someone to do a deal with you, the first thing I've got to tell you that's probably the most important is, do not call them an investor. I'm looking for investors. How many times do we hear that? I'm looking for investors. Anybody want to give me money? And I'm going to go out and do this and no. Okay. If you're going to use the investor word, then you need to start understanding securities law. And if you want a silent partner, that's an investor. If you want to take their money and make promises and lose it, you're going to jail. The person you're taking money from can throw the book at you for anything that could possibly go wrong and ruin and destroy your life if you call them an investor. Now, if you want to do an investor, it's cool, but you've got to step up and do the documents properly. We're talking what's called a PPM, a private placement memorandum, a Reg D offering. Are these accredited investors? Am I going to search for people on social media? Am I going to do a crowd fund? Am I going to do all these things?
Let me give you we're going to go deep here. Let me give you a basic scenario. So we're Seattle Investors Club. We have our weekly roundtable meetup that maybe you'll jump in like we talked about sometime here. Okay. So people come on our meetup and they're like, hey, I got a deal off in wherever, Everett, or I got a deal in Tacoma. And this is the deal. It's off market. It's a great deal. I've got it under contract. And they are who'd like to partner, right? So let's say we're on this call.
They use the P word. Love it.
Or I have 40 brokers and brokers investors underneath me on my little private inner circle thing. And one of them might come across a great deal, like a 14-unit apartment building, right? And they found the deal. So they're gonna grab that deal. But I'd like to get in the deal with them to help them with some of the equity that they need. As I don't want to be a lender, I want to be a true partner. Okay. And then somebody else wants to join in it as a three-legged partnership. That's the general contractor will do the value add for us. So we got the investor who found the deal, right? And they're going to manage it. Let's just say project manage it. We've got me. I want to get in the deal and pay for, give them some money as part of the equity that they need to close. And then we have a third person that's like, I'm the general contractor. I'll partner up and I'll basically do the physical labor where the other partner is going to do the administrative management and I'm going to provide the equity, right? And this is just comes up on a Thursday. Somebody's got a deal and says, anybody want to do this deal together?
Okay.
It's not advertised anywhere. We're just chatting as friends on a Thursday.
Okay. I like that they use the P word. Does anybody want to partner with me? If anybody in your meetup groups, and Julie, you and Joe, I would really make this recommendation, is that if anybody shows up in a club meeting or a meetup or around a table or whatever and says, I'm looking for investors, say, hello. Do not use that word. Do you have a Reg D offering? Do you have PPM? No, then don't ask for investors. You're really looking for partners. Okay, now we have to remember a partnership is a democracy. Whoever has the voting rights, vote together as a block. They can get rid of someone, not take away their ownership interest, but say, you know what, you're doing a crappy job. We can't take away your ownership interest, but we're hiring someone else. Well, I don't want that. I just want silent partners. That's an investor. So if you say, we're three of us are going to get together, someone's going to be the manager of the LLC and I found the deal, and the other one's going to be the money, and the other one's going to be the credit or the GC or whatever. That's cool. We do an LLC. Everybody's in on it. Everybody has a vote. There's ultimate disclosure. There's meetings every month, and it's an LLC. And we didn't even get into short-term or long-term, because when you say general contractor, I'm thinking, is this an ordinary income deal? Do we need to talk about S corps?
Let's call it long-term. Yeah.
Okay. It's all long-term. So the GC is going to build it to help rent it. And so all this stuff. So anyway, if it's long-term, we're going to do an LLC. We have a membership operating agreement, and we're clean. Everybody's involved. But the person that found the deal all of a sudden finds out that the two other people can vote them to stay away and they're idiot. They're not going to like that. And so they're going to try to find some grandma that's going to give them money and not participate. And that's the people we have to look out for.
In a three-legged partnership, right? Or, your other partners can vote to say you're doing a shitty job and put you on the sidelines.
Yep.
That solves a lot of problems, right? If it's written into your partnership agreement that way. Okay, good enough. I'm going to ask you some pointed questions here. So now let's say that I say, well, I'm doing more. How does the profits split go? Does it matter if it's unequal? Should it be equal, or does that come into play at all? Oh, well.
Now, see, this is the beauty of this. And I've got a great example of, I had a phone call with a client Sunday night on Valentine's night in tears, a grown man crying on the phone because
was it Joe?
yeah. He was like, my lift ticket, I lost it. No, but in a partnership gone bad, and I'll explain the situation in a minute. But anyway, when you guys get together and someone in the roundup says, you call them a roundup. No, you call it a meetup.
Sure. Roundtable, meetup.
Roundtable. There's meetups and roundtables, and I call them a roundup. See, that's Kohlerism. I just
You're in Idaho. That's what you do when you're in Idaho.
Screw it up. Okay. All right. So in one of these meetups, they say, I'm looking for 2 partners. Let's do it. And they meet after while you're eating donuts in the back of the room and go, okay, let's do it. Your next step is to involve a lawyer and draft a real freaking LLC. And if one of those bozos says, well, I've got a good operating agreement and I can file it with the state, run away. Now, here's why. They're playing lawyer now.
Wait, let me make a thing. So what happens, this is the mistake. People say, I have this deal under contract already, and I'm looking for partners. Let's just use the right word, partners. And I've got it under contract already. What does that mean? That means they probably have it under contract in the name of an LLC that they own.
Okay. I'm okay with that.
Okay.
It now may not be the LLC they ultimately use for the property. And so we can assign that contract to the new LLC of the new partnership. And you're going to have a real operating agreement with minutes that define what the percentage of share of profit is. What happens if we have to put more money in? What happens if all hell breaks loose with a pandemic? What happens if, So we want to have an LLC that defines the relationship between the 3 parties with its own bank account, with its own tax ID number, and darn it, it's going to do its own tax return. And if some of you are like, this is too much work, I don't like it. There you go. Now I have people at Denny's doing it on their own Word document on their laptop and think it's okay. And then they wonder why they're in a lawsuit a year later. People, do it freaking right. If you're going to spend thousands and thousands of dollars and hours upon hours on a project, spend $1,000 and do it right.
What happens if there's only 2 partners? How do you sideline the other partner? Is there just a clause written into the operating agreement if somebody's not doing their job? You figure when there's 3, you got 2 against 1. What about when there's 2?
Well, there's a whole other half hour. We could talk about what I'm doing to partner with someone else. What are some provisions I can put in there? Could I have a tiebreaker vote? We could agree on appointing a mediator that would break any tiebreaker votes on certain issues. We can agree that the person that's running the business doesn't need authorization for any expense under a certain dollar amount, and that we're going to have a meeting of the minds and an exit strategy. And so there's tons of ways to deal with it. Now, and on this note, Julie and Joe, you guys will appreciate this. I've been doing this 20 years. Now I'm trying to only maybe take one appointment a day of new clients. I'm trying to just maintain what's in my pipeline. I've got 7 tax attorneys any of you could have a call with that are Minnie Marks and Matt Sorensons. And we've got great team members. But here's my point. For years, if I just did 3 or 4 appointments a day, let's say 3 appointments a day, I would have 1,000 consults a year. Take out weekends and holidays, 300 days times 3, I'd be doing over 1,000 consults a year. Do you think I'd learn something separate from law school? Do you think I'd learn something separate than being a CPA, where I see clients that are killing it, doing it right, and clients that are blowing up with mistakes and jacked up? I see patterns of success. I go, oh my gosh, that is such a good idea. Well, we should put that in our operating agreements next time a client has that situation. So when you get on the call with me, you're not paying for me to set up an LLC. You're paying me for the documents that are correct and the 999 calls I had before you, because I'm going to share something you don't know. Right. And that's what you're paying for with the tax lawyer, is to say, tell me something that I don't know so I don't mess this up. Right. But they went on order and stayed at the Holiday Inn last night so they can do it themselves.
And you're going to end up spending way more money that you don't have probably in your problems and spending the money that you need to do up front. So just do it right. Yeah. So the big takeaway moment there is that, again, you're not looking for an investor, you're looking for a partner, and to be real careful with that. And that it is no problem to set up partnerships if you do it correctly. And you just need to essentially be working with somebody that knows how to have the clauses and all the history of all the problems on the earth that have happened to make sure that your documents cover those things, right? I mean, let's Keep it simple.
And you're going to say, well, Mark, can I use a JV agreement? Sure. We use JV agreements in certain situations too. We could have a whole podcast of when to use a JV and when to use an LLC. That's a whole topic.
What's
I have
the difference
articles on that.
in an
And
LLC?
so, pardon?
What's the difference on a 30,000 foot level from a JV versus an LLC?
A JV agreement is a general partnership where you have general and vicarious liability between the partners. A JV agreement is a one-off where you may just have a short, simple relationship for a quick transaction where entities are doing a JV and not people. A lot of times a JV does not have as much exposure, but we need to have some sort of record of how we're splitting the profits on a project. But a long-term relationship, the example you gave of 3 people doing a rental, I'm never going to do a JV agreement because that's a long-term relationship. Now you come in and say, oh, on a meetup roundtable, someone came in and said, hey, I've got a property under contract and I'm wholesaling it. I need $5,000 for the wholesale fee, and my deadline is Thursday, and my money is soft right now. It goes hard on Thursday. Anybody want to throw in an IRA or a 401k for this? And we'll put a JV together. Okay, do I have a lot of exposure on a wholesale deal? No. A JV agreement could work fine. Is it still a partnership? Yes. And who's going to be the partners? And do I have a 2, 3, 4-page JV agreement that deals with tax reporting and duties and responsibilities and all that? Hopefully. But that's a different scenario. So different types of partners and 401ks and IRAs and people and timeline and turnaround and deal. I might lean on a JV agreement versus an LLC, but definitely not a napkin at Denny's, which is often what happens. But
I hear you. Again, sign up. Let me ask you another question. If there is unequal distributions within a partnership, right? Does the income follow the distributions? I mean, the allocations, right? Let's say you have a 50-50 partnership for some reason, or a 3-way partnership for some reason, and somebody gets more distributed than the other for some reason. Does that make any sense to you?
Yes. What those are called is special allocations. This is a 2-month section in a master's program in taxation. Special allocations, we do not use those with IRAs or 401ks and retirement plan LLCs, FYI people. Special allocation says that if me, Joe, and Julie are doing a deal, Joe may want the cash flow, Julie may want the write-offs, and I may want the equity when we sell. I don't know. That's called a special allocation. It requires an accountant that can handle a very complex 1065, and you can agree to those sorts of things. I would say they're 1 in 100 at our firm. Very rare. They're very complicated. They usually have a lot of zeros involved. So be careful if you're going down that path thinking you can just hack it out based on a Google website article. So be cautious.
Okay. We're getting long in the tooth here, but I'm going to ask you one other question.
Okay, and I want to tell my story too. Got to save me time for my story real quick too when you're ready.
One more question, and then you tell your story. So, I think real estate investors and lots of people in general are really wanting to write off all their expenses all the time, down to their 0 tax liability, and I always tell them, don't forget, you might need to borrow some money. So you got to check in with your lenders also when you're doing your plan for the year on, how much you need to borrow, because if you write everything off, you might not be able to qualify for a loan. But I want to ask you a question that I've always wondered about. So does it make any sense to weigh how much business write-offs you take versus the opportunity to contribute more to like your solo 401k, if you know how to make good returns, if you're an investor that knows how to make good returns, or somehow you know how to make good returns. Does that make any sense? What I'm asking you is your contribution to your 401k, right? You want to maximize that, right? But you have to, is it calculated after you do your write-offs? So if you're good at making investments in your 401k, is it okay to have higher income so you can put more money in your 401k versus write everything off to save on taxes? Do you get what I'm asking? Is there a balance, that an opportunity cost balance there? Should I try to keep my taxes lower, or should I try to maximize my 401k since that contribution is calculated off ... what? Does that make any sense?
You say and I'm going to give you a couple definitions here. You ask good questions, Julie. You phrase it. I'm going to restate it for everybody. Do I look to get the most write-offs and possibly a loss in my business or personal return at the end of the day, versus should I put more money in a 401k? You phrased it as if it's either.
Should I watch where my income is? Should I try and manage my income level between the balance of, I don't want to pay a lot of taxes, but I want to max out my 401k because I actually make more money investing in my 401k because I'm a good investor versus my savings by not having a higher tax bill? I guess my question is my 401k calculated before or after my expenses are taken into consideration? Is my contribution to my 401k calculated before or after my expenses? So if I write off,
I got you. Let me respond. I just got to think of how to. The first thing I was going to say is it's not either or. It's not should I do this or do that. You try to maximize both, but then you say, is the 401k before expenses or after? The answer is during. The 401k is one of the expenses. So, and this is why November and December are so busy for us, because real tax planning is at the end of the year. April 15th, I think I'm going to Mexico. I don't care. April is not a big deal, because if you're a W-2 wage earner and you're running down to H&R Block or Liberty Tax or TurboTax person, fine, go ahead. But my clients, they're not ready to file in April anyway. They're waiting for K-1s. They're massaging their 1065, their S Corp. They're still deciding what they're going to put in their 401k for last year, Julie.
Right.
And so but anyway, so this is going to answer your question. So in November and December, we are absolutely swamped. And we actually have told I could talk into our policies on vacations during that period too. But we're so busy because clients are calling up going, how much should I put in my 401k? How much can I? Should I put my spouse on payroll, contribute to his or her 401k? Should I put my kids on payroll? Should I be funding their Roths? Am I going to put money in my HSA? Well, I've got a lot of medical. Should I do an HRA? Should I buy a vehicle before the end of the year? Should I go out and buy this equipment before year end? Am I doing bonus or am I doing actual depreciation? See, all those questions that I just rattled off come January 1st, over with. Can't do it. You got to plan all that in advance. So what I want clients doing is in November going, all right, I got a solo 401k, and your 401k contribution is primarily driven by your salary, not your profit. You could have a loss and I could still max out your 401k. Okay, that's why I was going to say it's not an either or.
It doesn't matter. I could write off everything under the planet as much as I want, and it won't affect the calculation of what I'm going to put into my 401k.
You're killing me, Julie. It'll affect, but okay, let's do. Now, this may bring up what I call the backdoor 401k. I'm the only one that's got a video on this on YouTube, the backdoor 401k. Let me give a couple quick examples. Let's say you have an operational S Corp. You're doing fix and flips and rehabs. You've got to take a reasonable salary. Your salary is based on your draws, not your profit. So if you're taking money out of the company, I've got to peg a salary for you called reasonable comp to nail it with the IRS. I have a whole chapter in my book on the payroll matrix and where we need to be. But notice what I said. I don't care if you have a loss. I care what your draws are and what your payroll is. So you're going to do $19,500 this year for 401k plus 25% of your salary. Now, I call this the sweet spot of nailing your salary. That's another video on my YouTube. Make sure you put sweet spot 401k salary, not sweet spot something else. I'm not liable for what video you'll get. Okay, that was a good one, right? That's one of my own jokes. I made that one up.
Hey,
okay,
Joe,
but anyway.
That means that we get to censor this podcast. All right.
Yeah, that's right. Okay, so sweet spot. But see, you're going to nail your salary and draws in order to maximize your 401k contribution. And I haven't even started on your spouse, which is another video. Should I pay my spouse and how much? So we're trying to figure out that sweet spot to get a trifecta of all those factors. Your profit really doesn't matter. When you say it doesn't matter at all, no, because your draws matter more, and that's your 401k contribution and allocation and match. And I can do the match next year. And so much there. Okay. Now let's say you're all rentals. You're like, Mark, you've got them at your round table, right? They have no operations. They do no fix and flips, right? I bet you half your round table are just day job or no day job, and they have 20 rentals. Fair? Right? That's all they do is manage their rentals. Can they put money in a 401k? No, they don't have earned income. It's passive income. And then they go, well, I'm maximizing all my depreciation. I've made the real estate professional election, huge topic of mine, whole chapter in my book. And so they've made that's what Donald Trump only paid $600 in tax because he made the real estate professional election. I loved it. I looked at both Joe Biden's and Donald Trump's tax returns on my podcast, and we went through them. Joe Biden had a rental. Joe Biden had an S Corp, but he wasn't a real estate professional. He was an author after he left the vice presidency, had a $13 million paycheck for his book, or I should say, I want to say royalty, but in advance. He ran it through his S Corp. He took a small salary, loved it. Donald Trump made the real estate professional election, drove all the depreciation losses through there. And so any of you that are in a round table and you're being a real estate professional in a bunch of rentals, you would love to make a 401k contribution. You can't unless you do the backdoor 401k. So what I'll do is set up a management company to pay you to manage your own rentals, which I would never do. I would never do that. Any bozo out there that's telling you to set up a C Corp in Nevada to manage your own rentals, scam. But I might set up an entity to manage your rentals if I want to do a management fee over there and then spill that all out and zero it out and contribute to a 401k. I can still have a loss on my passive side. I can have a loss on my operation side and still max out a 401k. It's not either or, it's both in a coordinated attack. This is why tax attorneys make good money, is because I'm saving you 100 times that. But heaven forbid, Mark Kohler, $600 an hour or $400 an hour. I've had people who say, Mark, I'll pay $1,000 an hour. Get me on your calendar. I'm like, no, I turn away. That's how busy we are, because people know that when they pay me, they're saving 10 times that. And if your attorney isn't saving you 10 times every time, whatever you pay him, you got the wrong advisor. Sorry, I'm so passionate today, Julie and Joe, but does that help, Julie, answer the question too,
yes.
Right?
Yes. Well, guys, we're making him sweat. That's good.
Getting mad. Anyway.
All right. Well, we're going to twist your arm to come join us on a Thursday and preach at us sometime. But let you tell your story, and then we'll cut you back.
Okay, I know Joe had some comments too. He's being quiet today. Okay, real fast. I'm not going to use names or locations to protect the innocent here, and I try to respect that attorney-client privilege very cautiously. Client several years ago had a rehab, needed some money for rehab, goes out looking for hard money, right? He was borrowing money from a variety of investors, putting him in second or third position. It was going to be a great payout. He got a great deal on it. And he was just one-offing 2 or 3 or 4 lenders to do the rehab. Makes sense. He signed notes with these people. They weren't getting any of the upside. They were getting points and interest. They were lenders. He was not forming an LLC with a bunch of silent partners and needing a PPM. They were not investors. They were lenders. They got a note and a mortgage trustee note recorded. Clean. Well, he needed a little more money. And this other guy's like, well, hey, I want to partner with you on it. And he's like, okay, but I also want to put money in. And he goes, well, I'll loan, let's say I'm going to say 50 grand. It was a different number, but I want to keep it private. So he said, I'll loan 50 grand and I'll help work on it. And then I get a piece of the profit too. And they figured out a percent, which can vary. Like you said, Julie, we're going to do that. Well, this real estate professional wrote all of the agreement up himself in an email, no contract, no LLC, They had this handshake deal, essentially, is what this email was about. And the guy threw in his 50 grand. Now, they off to the races. My professional thought he was a partner. And so did this guy that loaned the money. Well, the deal starts to go bad. Oh, no. So now they're losing money. They're trying to pay off the other lenders. The project's not going to make as much as they thought. They're now starting to lose money. Oh, interesting. This person that put in the 50 grand says, oh, I'm not a partner. I'm a lender. He's like, what? Hold on. We're partners. We've got to share you get a share in the upside and you got to share in the downside. Well, I don't want to do that. I just want my money as a lender. Well, hold it. When we were making money, you wanted to be a partner. Now that you're not a partner, you want to be a lender. You can't pick and choose. And so the lawsuit begins. 3 years of offers back and forth and threats and public slander and fights and wives in the mix and lawsuits, all because they didn't pay for $1,000 approximately to get it documented properly from the beginning and file the right tax returns. It was a freaking handshake like 90% of the real estate investors do out there because they don't want to pony up. They want to cut corners, watch Law and Order, and stay at a Holiday Inn. It doesn't work. So this client on Sunday night was on the phone with me in tears, coming to the final lawsuit piece of it. And it's just a mess. And I felt so bad for him because he had tried to do the right thing all along. And this person was holding him ransom and extortion, frankly, in my opinion. So people, you think, well, we're going to make money. That's not going to happen.
Well, you know what? You know what's a good tip is when you guys are looking for partners and or lenders, however, whatever you're doing, get extra money, add on top of the deal, the money, the $1,000 you need to set up the LLC and maybe the first year of your tax return. Just include that in the deal. So everybody's always focused on, I need money for my equity or my rehab or whatever. Add on an extra $2,500 for your legal on any time you're doing a deal. Just that's part of what your partnership agreement contribution includes. And even write it in there, right? Exactly.
Totally. And we put together packages for clients that are doing 3 rehabs a year or 4 rehabs. We've got a standard LLC. They're already familiar with it. It costs X. We do a phone call with the partner. We have the phone call. We give them the LLC. They sign it. Boom, bada bang, boom, bada bang. So can we create some cost savings and some efficiency there? Absolutely. If you're going to do these every freaking 2 months, let's get a system down. You work with the same lawyer in my office, the same accountant. And again, if you're not working with my firm, find someone you can work with. And then you build a system.
If you're looking for partners to do this sort of thing, how much of a player do you look like when you have this sort of system set up? Now, you want to do this more than once with that partner or other partners, and the word spreads how systematic and prepared you were. Right there, that is going to earn you the street cred to do more deals. If you say, hey, part of my partnership setup is that part of the equity contribution is $2,500 to cover legal and tax to get it set up straight from the beginning, right? And that's how I roll. And I only want to.
Did you call that street cred?
Yeah.
I love that. Is that yours? Where'd you see that?
Oh, I steal everything. So I'm
okay. So can I use that street cred? Sure. Okay. I don't have to pay any royalties
on a Thursday. Okay. If you show up on a Thursday, that's the trade-off, right?
I need street cred. All right. I love that.
Right. So just that solves it right there for all of you who have a hot little deal in your hand that are planning to bring it to our Thursday roundtable meetup from 11:30 to 12:30 every Thursday on Pacific time here. Remember that you're going to be getting an extra $2,500 in that deal to cover the entity setup and the first year tax stuff. So then you're going to look like the man or the woman. We'll use it so you have street cred. There you go. We'll call it, hey, Mark, you could call it the street cred package.
There you go. I like it.
Right? I'm going to put a package or some copyright on that name and I'll get a royalty off you for using that.
Yeah, I love it.
All right, guys.
Well, speaking of the man, Does it Joe? Did Joe have something for me?
Joe is the man that makes it available for all of us to even be doing this today, right?
Oh, use your tech.
I clearly can't even get my right name on the computer that I'm using, so we all know how I roll, and therefore Joe is my better half of keeping us, giving us some street cred. Actually, even just getting us on the street because. Yeah. Otherwise, we wouldn't exist.
Yeah, he's your Mr. Robot. He just makes it all happen on the computer.
He makes it all happen. And yes. And so let's wrap it up. Anything else we want to add today? Let me just one fun question at the end. Besides being a spokesperson for products such as whatever you're drinking today, and what would you do if you were not Mark J. Kohler, tax legal expert? What would you do? What would you have done with your life? Ski instructor? Oh, what would you have done? We want to know what would you do?
I'd be living Joe's life. That's what I'd be doing.
We all want to live Joe's life.
I don't know. I really feel I'm going to answer it this way. I think one of life's biggest challenges is finding out your what. Who are you? What are you good at? What do you enjoy doing? And who are you? And I like that question is, Mark, if you weren't doing this, what would you do? Part of me wants to say, I wouldn't be doing anything else but this. That's who I am. I found that.
Because I like what I do. And I think it's okay you don't have to always have plan B because plan A might be great.
Yeah. I want to modify it a little bit. I am working a little too hard nowadays. I'm getting a little older and I got a great team and I do want to ski a little more, do a little bit more hobby stuff, but the day before I die, I want to publish a blog article. I want to do a podcast in the morning and kick the bucket in the afternoon. I want to die doing what I'm doing. And I'm hopefully helping someone out there if I share a little bit of my personal experience and the experience of all of our clients, and help everybody just live their piece of the American dream a little better. And so
Mark,
I'd love to come back.
I have a tip for you that I want to make sure that you know today. If you start a side gig, okay, I want to make sure that you get that set up in an LLC. All right. Just make sure that if you start a side gig.
Yep. I love it. And I'm going to give away, if you tell me you choose a winner from your podcast, I will personalize a tax and legal playbook and we'll send it to them for free. And if any of you want to get started with just a good podcast on the tax and legal parts and maybe self-directing, I have 2 podcasts every week, the Main Street Business Podcast and the Directed IRA Podcast. And you just throw those in Stitcher, Spotify, or iTunes and you'll find them quickly. We've had over 1 million downloads. My YouTube channel, so much free content there. Mark J. Kohler, please subscribe, hit the bell icon. I go live every Thursday on YouTube and Facebook answering questions.
Well, hopefully it's not at 11:30 Pacific time.
No, it's 4:00 Mountain. So it'd be 3 Pacific. And, but I'll send out a copy of this book. And for those that want something to put their hands on and read and make notes, it's a great book. Tax and Legal Playbook on Amazon.
Pull it up for us again and tell us.
There we go. Tax and Legal Playbook, 2nd edition, and tables in the back, 32 chapters on different topics. So you can read a chapter on a specific thing. Like there's a chapter 19, protecting your home from a lawsuit. I'm just flipping to number 16, tax saving strategies for selling property. Then I'm just flipping through.
There you go, guys. A great spring break book right there. I'm always looking for a spring break book. Let's try that 3 times, saying that. So, all right. So what we're going to do is first one Joe, what can we do? How do we get somebody this book? What do we want them to do to get this book? Should they make a comment on our YouTube page or something? What?
Yeah, let's have them make a comment on the YouTube page, but what should we have them comment on? Or what should we have them say? Or what should we have them tell them about or tell us about themselves?
I don't know.
How many rentals they own. And if you're going to buy your first rental this year, you say, I'm positive declaration. I'm going to buy a rental this year. or I already have 3 rentals, and if you don't want to share that and it's private, share one of your best experiences about rentals. I have a rental that cash flows $320 a month, or I have a rental that my kid lives in while they're going to college, or I have a rental next to my mom and I check on it every time I visit her and write off my travel, or I have a rental by the Dallas Cowboys Stadium because I have season tickets to the Dallas Cowboys. So have a reason why you buy a rental. I love to do that, but that podcast for myself, I ask people, why did you buy a rental? Well, for tax benefits. Nope, got to have me something better. Let's not let the tax tail wag the dog. What was the life reason you bought a rental? Well, it's my mom. She lives in it, and I bought it from my mom so she could get Medicaid, and I rent it to my mom, but I gift her the money for rent. So you get a tax. There's so many reasons to have a good rental.
That question, I'm going to just recap it. What is your question to get a autographed copy of Mark's book is, what is the life reason why I bought a rental?
Woo!
That's
Love it. Okay.
That's it. All right, Joe.
Thanks for having me.
Yeah. I want to just do a reminder again, everybody, that again, I'll say it again, you can join us every Thursday. Joe, how can they join us on Thursdays? What do they do?
Yep. Just head over to our meetup page at seattleinvestorsclub.com/meetup or meetup.com/seattleinvestorsclub. And that will send you right there, give you all the information that you need. Or you can email me, Joe, at seattleinvestorsclub.com, and I'll give you all the information. Any way works.
And you can grab our Zoom link, which never changes, right? And you can put that into your calendar every Thursday, that particular Zoom link off our meetup page. And it is the same every week. If you want to put it on your calendar every week, the Zoom link does not change. Is that correct, Joe?
Absolutely correct.
Awesome. Good stuff, guys. Well, make sure that you go check out. We have hundreds of podcasts, and we also record. In 2020, we recorded all our weekly masterminds. They're all recorded, and they are all available on our YouTube page for Seattle Investors Club. In 2021, we are still recording those, but you have to be a member of Seattle Investors Club to get access to the recording. We gave you guys a free pandemic year, and now it's just $220 a year. And sometimes we give discounts and freebies. Maybe we'll do an Easter one coming up here. But that's how you will get access to the recordings of all our weekly masterminds, major nuggets, special guests, resources, tips, deals, whatever. And you can get access to those on seattleinvestorsclub.com. All right, Joe, where can they find the details of today's podcast?
All the show notes are at seattleinvestorsclub.com/140. That is the number 140, and it will get you right there to everything you need.
All right, guys. Mark, thanks again for goofing off with us today.
Thanks for having me.
Crazy and made you sweat, but it was kind of fun to watch, I'll be honest.
Yeah. No, you ask hard questions. Thanks for having me. And people, don't give up. Keep studying this stuff. You'll geek out on it and love it. It'll make you money.
Geek power. All right. Over and out. Nerds rule. See you guys.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.